Joining me now for a closer look at what's playing itself out in the market scene is Seleho Tsatsi from Anchor Capital. Seleho, pleasure. Good afternoon.
Afternoon.
Wonderful, Seleho. Maybe we can start off by just recapping what we are seeing on our local market there. It's just volatility all around. You literally open your screens and you never know what you're going to get.
I think that sums it up perfectly. What's really driven the market in 2024 has been the resources sector. So after quite a tough end to 2023, that sector has really been the largest positive contributor to overall market returns by some distance. Within that, it's really precious metals that are driving resource returns. You have gold. Obviously, gold prices are at all-time highs. But then within PGMs, the platinum group metals section or part of the market, I think investors are trying to ascertain whether or not we've hit a bottom in that cycle.
I must ask you, Seleho, if we are bound to see macros that would give rise to a better resource performances. We need this here in South Africa. We need our resources to enjoy a little bit more optimism.
Yes, I definitely think it depends when you're talking about resources on which part of the market you're talking about. So within gold, it's quite fascinating because you're seeing gold prices hit all-time highs at a time where expectations for rate cuts from the Fed have come down quite significantly. So there's a bit of a, that's a bit of a head scratcher, I think, for traditional theories on when gold goes up. Within PGMs, I think if you look at where prices are, and if you look at comments, for example, from the Northam CEO, he recently said he thought this downturn was the worst he's seen in decades for the sector. So I think even though share prices have started to rally in that sector, operational performance still remains very challenging. But it is encouraging to see an uptick in base metals and bulks, the likes of iron ore prices.
You did touch on the US there, what we're expecting with inflation. Let's also get your thoughts on that one. We are just seeing this higher for longer narrative persist, Seleho. But first it was higher for longer, and now it's higher for longer than the longer we initially thought would be longer.
Yes, it feels like we're going from one narrative to another. Initially, it was inflation was transitory, and then that kind of didn't work out. And then it was, okay, we're going to get 6 rate cuts. That was the idea at the end of last year. And now we're looking for 2, with the first coming potentially in September. So we've had huge shifts in expectations. I think the equity market in the US has been quite slow to react or incorporate this feedback from the Fed into equity prices. This week, Jerome Powell, the head of the Fed in the US, indicated that, as you said, higher for longer is likely to be the scenario going forward. So the market is now pricing in 2 cuts for this year, actually slightly less than 2 cuts. And I suppose whether that actually comes to fruition depends on what happens with inflation data going forward. So we'll have to strap in and see.
Now, what we have seen an absolute green shoot, amidst all of this, is with semiconductors, with chips, with AI. Let's talk about TSMC. I think they came out there with numbers that really surpassed market expectations. This is just where those who are, able to invest are able to go and hide. This AI boom really does persist, and to my surprise, Leo.
Yeah, so TSMC is the biggest foundry in the world. So they produce chips for all of the majority of the semiconductor companies that design chips, the likes of NVIDIA, not ASML, but Qualcomm, Broadcom, etc. So they provide a really good feel for what's happening within the sector. They've said that they expect earnings to recover this year. Last year was a down year. The industry has went through a bit of a pause or a down cycle, but they're expecting that to recover in 2024. They're expecting growth of more than 20% for the full year for 2024. So quite a strong year. And as you said, it's quite a nice way to get exposure to this AI theme. AI, or let's call it GPUs, remains a relatively small proportion of their total the total part of their revenue split. The one thing you need to keep in mind with TSMC is geopolitical risk. So there are, Taiwan and China, they are largely based in Taiwan, and potential conflict between the two regions remains a concern.
I must ask you, Seleho, we know that NVIDIA's run quite hard. For a retail investor looking to go in on these GPUs, on these semiconductors, TSMC, might that be a cheaper option for them?
It's certainly, yes, it is certainly a cheaper or lower value share, lower PE than NVIDIA, for example. Although what's interesting about NVIDIA is, despite the meteoric rise in the share price, the multiple isn't, you would think that the forward PE multiple would be something like 50 or 60 times. It's actually more in the 30s, which, isn't bargain basement levels, but it's not what you would think after the rise that the share price has had over the past, let's call it 18 months or so. And then outside of that, there's a plethora of other semi companies you can look at. For example, AMD's had quite a big pullback. That's only up 4% now year to date. So there's a lot of digging that investors can do.
Also keen to touch on Tesla with you there. They're battling quite a bit. I'm not sure if it's because the EV market is just experiencing a bit of a downhill in demand, or if it's also just specifically Tesla related, where they do play in the premium EV sector.
Yes, there are a few, I think, factors that have come together and led to this pullback in Tesla's share price. The share price is down, I believe, 37% now year to date. I think the first factor is, as you said, the EV market has had quite a slowdown this year. So it's not just Tesla, but the rate of growth in penetration of battery electric vehicles as a proportion of total vehicle sales has had a slowdown. So it is still growing, but the rate of growth is slowing. And then on top of that, if you look at Tesla's valuation, obviously there was a lot baked into the share price before this pullback. So even today, the business is valued at about $500 billion, which obviously, if you look at it from a traditional auto vehicle valuation, you would say, okay, it's hard to get to that valuation. But bulls would say, this isn't a traditional automaker. You need to look at this more as a software business going forward or in the long term. Elon Musk obviously is often touting the impact that FSD, full self-driving capabilities, will have on the sector and society. So it's one of those stocks that really divides bulls and bears. Even after this pullback on traditional valuation metrics, it still doesn't look cheap by any measure. But the bulls will counter and say, this is likely to be a winner takes most market, and what's to come from Tesla in terms of its computing abilities is hard to factor in or quantify.
Well, Seleho, with that said, I'd like to get your stock pick, but first, let's reflect on counters that have found favor with your industry peers.
I took a bit more defensive position against the geopolitics and now went with Lockheed Martin. It's a defense company, US-based, predominantly US government contractor, and they are getting new orders as the tensions rise in the global scene. I think the Russia, US, Europe tension, the stock might benefit from that. It's not expensive. I mean, it's trading at about 16 times, and certainly a business that has a relatively stable earnings stream. So it's a business that I think would provide some defensiveness against any geopolitical risk if it does materialize.
I'm going for Netflix results coming out now. Maybe wait for the results first. I think they're going to be quite good, but there is some risk in that. So I'm taking Shapiro's place today. I'm buying a bottom left, top right, bottom left, top right.
It's going to be Supergroup, largely due to sort of the same sort of defensiveness. Supergroup prices in the South African market similar to something like a Motors or even a CMH, which is one part of their business, but it's a much more diversified sort of company. So they do fleet services, which is sort of company vehicles. They do logistics, which in South Africa is an incredibly strong business because they're competing with Transnet, which is not a very strong competitor. So you're getting exposure to sort of high coal prices and potentially, if things really go wrong, down, let's say down, something like manganese or iron ore prices, but overall coal prices, which have been decent if you look at something like Tungela's earning. So you get that, and then a large part of the overall group earnings is based off an investment in Australia called SG Fleet, which is a fleet services business. So if you look at Super Group as a company on the main, you've got a massive sort of currency hedge in Australian dollars for 20 to 30% of their earnings. And then you've got cheap businesses, which are motor dealerships and car rentals, and all of those things are doing fairly well defensively. I mean, Super Group's earnings grow at 15 to 20% annually at a very constant rate, and they're paying a good dividend. So the stock's derated in line with sort of competitors that are maybe not fair competitors or fair comparables. So I think at the current price, which is sort of a drawdown of, maybe 20, 30% from last year, September, with earnings growth, that's some of the best value you see on the JSE at the moment.
Well, Seleho, keen to get your thoughts on some of those, Lockheed Martin, Super Group and Netflix.
Yeah, so maybe I'll start with Netflix, given that they are reporting tonight. And I think it's a business that is always topical in the sense of most of us being consumers or, signed up to the actual service itself. What's interesting about Netflix is it's had a really strong run from its 2022 lows. So it's more than tripled from those lows. And investors going forward are expecting decent revenue growth, but it's more about margins really expanding. So because it's a business with a high proportion of fixed costs, if you think about it, if you or I are a new Netflix subscriber, it doesn't cost Netflix a lot to serve that additional content to you. And so as they grow that subscriber number, they should be able to grow margins quite strongly. For the first quarter of 2024, what they're going to report tonight, expectations are, what the company's guided to is for very strong earnings growth because of margin improvement. I think long-term, the question is, what proportion of global households can Netflix capture? Before that 2022 stock price crash or worries that investors had, the idea was that there were 800 million households outside of China that they could address, and they could perhaps get to somewhere around 400 to 500, maybe even higher. They currently have over 200 million. And so I think that's really the question. If you look at their competitors, the likes of Warner Brothers, Paramount, which is actually in the process of selling itself. Paramount owns the likes of Viacom, Nickelodeon, BET, etc., MTN. Those companies have quite a lot of debt and they are subscale. So you could say that they're in quite a good competitive position and they have a strong hand. It's really the likes of Amazon, Disney, you would say Apple, but to a much lesser degree, that are providing a different type of competitive influence to Netflix.
With that said, Seleho, keen to get your stock pick for this afternoon.
Yes, it's one I've provided before, and I hope I'm not going to become a stale bull on this, but it's Tencent. I'm sure I'm not the only one that's come and peddles Tencent ways on here, but it's a very interesting setup. Last year, Tencent's free cash flow grew by just over 60%. Non-IFRS earnings were up over 30%, yet the share price was quite lackluster or muted. They are returning an increasing proportion of cash back to shareholders. So it's a dividend yield of about 1%. I acknowledge it's not much, but the buyback equates to about 4% of the market cap. So they're returning about 5% of the market cap back to shareholders. They've said that in the second quarter of this year, they expect the gaming business to re-accelerate growth. And it's a business with huge network effects. 1.3 billion WeChat users. They own some of the largest video game AAA titles in the world. And so I think as an investor, you can feel quite comfortable, at least in terms of the titles it owns within the video game space, that it's got a good position. And within China, it obviously has a very strong position with WeChat and social messaging. So that will be my pick for today.
Brilliant, Seleho. A pleasure having you with us this afternoon. Thank you so much for joining us. That was your midday markets update with Seleho Tsatsi from Anchor Capital.